Okay. So that's really, I mean, as funny as that sounds, that's pretty much very accurate in terms of what actually took place with the subprime market, and hence, at the moment, I believe, is probably one of the best times that I've seen to buy shares and property. Now, and I'll talk about property in the next section, but what's happening at the moment is the fundamentals are still the same, but the assets itself are losing value because of market sentiment. Now, to give you an idea of the market, 95% of the market is driven by people who speculate, and 5% is driven by investors. And they're the ones that are actually capitalising on the current opportunity and buying properties and shares because they know how to make a decision based on fundamental analysis, when majority of the people are selling, panic selling, and going with the general trend. And this is really where opportunities like this only happen a couple of times in a lifetime, I believe, and it really separates the people who can take advantage of opportunities like this versus ones that don't really know what to do because they don't know how to do proper analysis of the opportunity. So I'm very excited about the market at the moment. It's probably the best opportunity right now to buy property and blue chip shares in Australia that I've ever seen in my investing career of the last 12 years. So it's a very exciting time. So let's talk about different types of lenders, and also in terms of, and this is what I'll cover today in some detail, the process of actually getting a loan and what you need to have prepared, and also different types of finance that is available for you as an investor. Now, who's a property investor in the room here? Or who's an aspiring investor? Yeah? Great, so most of you. Even if you are not into property investing and you just want to look at share trading or any of the other strategies that we teach, this is still pretty much important to you, because eventually what you find is you'll be refinancing something that you own or someone else's property or your own property in order to unlock equity to put into that particular strategy. So with 21st century finance, we do all the research for you. We've got over 1,500 loans, and the most important thing is why I'm showing you this information is because the type of questions that you ask yourself as an investor and the type of questions that you prepare to ask the mortgage broker will largely determine your level of success. So the type of questions that you ask will actually determine to a large extent your level of success as a property investor. Most novice investors ring our office and ask us, what is your lowest interest rate at the moment, or what's your cheapest standard variable rate? Sophisticated investors ring us and say, what is your best structure at the moment that will enable me to buy another 2 properties with the maximum loan to value ratio? Or what are the lenders that you currently use that don't use PMI and use Genworth as the lender's mortgage insurance underwriter? So the types of questions that you ask will largely determine your level of success as a property investor. So I'll cover some of the questions that you need to be preparing mentally if you want to enter the property market. We've got basically industry-leading research and software. We aggregate through Plan, which is the biggest aggregator in Australia. So we pretty much have access to all the lenders. We've got a high level of service and operate under a strict code of ethics. We also what we do is, like any other financial broker, we can only give you the products that you want. Now, that sounds simple, but what a lot of investors don't understand is that the mortgage broker or consultant is just a human being, and your ability to explain what you need will determine the outcome that you get. Who understands that? So the more knowledge you have about finance and the different features of different products, the more clarity you have about your kind of product that you are seeking, and the better conversation you can have with a mortgage broker or a financial consultant, meaning that he'll narrow down the product range more specifically to suit your needs. So most people don't invest in property, or they have a bad experience with property, or they don't know how to get started because they don't even know how to have a conversation with a mortgage broker. They don't even know what to ask, and they have no idea about the products that they actually are out there, or the products that they need to get them from A to B. So this is a loan assessment criteria that I've come up with, which basically is just a very generalised, quick version of what you need to go through when applying for a new loan, refinancing an existing property, or building a large property portfolio. And it's an acronym called SLICE. Now, I'll cover these individually, but SLICE stands for security, location, income, and character, and equity. So basically, these are the 5 key things that any lender looks at when they are lending you money. So I'll go through these individually. The first one is security. Different security classes determine different loan-to-value ratios and different interest rates. So we've got residential versus commercial property. Generally speaking, on a residential property, you can get up to 100% finance, 100% LVR. So you're buying an investment property, $400,000, you can get $400,000 in terms of a loan. Plus then there's mortgage insurance capitalised. I'll cover lenders' mortgage insurance as well. If you're buying commercial property, the maximum you can borrow is 70% loan-to-value ratio. So you've got to put in a 30% deposit. When you look at different security classes that are accepted, you're looking at residential homes. This is probably the most preferred types of asset class that the banks like. And I'll cover these and I'll give you the reasons why. Townhouses, units and apartments, serviced apartments, and rural property. Now, if you're looking at from a lending perspective, lenders and banks make a lot of money by analysing the deal and basically hedging their risk. They don't take a lot of risks. So what they do is they always look at the worst case scenario. So when you're going for a mortgage, they always think, what's the worst thing that could happen? Number one, the person would lose their job, wouldn't be able to service the loan, or the tenant wouldn't be able to service the rental, or whatever happens, and how do we get our money out of the deal? Who understands that? So they look at the worst case scenario. So what they do is, when you're looking at a property, for example, whether it's a commercial property or let's say it's a serviced apartment, and the lenders are telling you that they're only going to give you 60% loan-to-value ratio, that's actually a very interesting thing that they are telling you. They are telling you effectively that in the short term, that asset could actually drop by 40%. So the risk assessment is done for you to a large extent by lenders. And I'll give you an example how important this is, because a lot of people are not aware of it. Now, if you're looking at, for example, and I'll pick up Melbourne, for example, the worst suburb in Melbourne, when I ask this question, I always do a different state, so I don't offend anyone. Anyone from Melbourne? Great, okay. If I ask the question, what's the worst suburb in Melbourne? People say St Albans, for example, okay. Now, if you go to St Albans and you buy a property between the petrol station and a drug rehab centre, okay, and you go to the National Bank will give you, providing it's just a normal, typical property, they'll give you 100% loan-to-value ratio on that property. Okay, so you can pretty much, if it's a $300,000 property, you're going to get $300,000. Now, NAB shares are fairly blue chip, apart from the last, if you take the last month out of the equation, they've been a fairly profitable company, blue chip share. Would you agree with that? If you go to NAB and you get a private banker, or if you just go to margin lending department of NAB and say, listen, I want to buy $100,000 of NAB shares, what's the highest loan-to-value ratio that you can give me on NAB shares? Can anyone call out any numbers? 60, 70%? Yeah? So think about what they're telling you. They're willing to give you a maximum of 70% LVR against their own stock, but they're willing to lend you 100% against the worst house in the worst street in the worst suburb in Melbourne. Think about what they're telling you about the underlying asset. They're really telling you with LVRs, loan-to-value ratios, that this particular stock has a tendency to drop up to 30% in the short term. Where they know historically that houses pretty much are, they say, as safe as houses. So when people tell you, or lenders say there is a lending restriction against serviced apartments, or there are postcode restrictions around major capital cities, or there are acreage restrictions, anything over 100 acres, they're really telling you that there's a possibility that that asset could drop in value short term, or that asset isn't as liquid as your residential property. Who understands that? So it all has to do with liquidity. How quickly they can sell it, and what is the potential for that asset to drop in value. So if you want to do a very quick understanding of if you're looking at buying a property, if there is a lending restriction on that property, that's a good sign, because they're telling you there's a problem with it. So any serviced apartment, for example, less than 500 square metres, has a lending restriction. And there's a good reason for it, because the property market is underpinned by owner-occupied sentiment. 70% of the property market in Australia is owner-occupied. This is unlike any other market. Now, I'm not bagging shares here because I trade options, but this is the uniqueness of the property market. 70% of the property market has people in it. Only 30% is driven by investor sentiment and speculation. Now, the share market is completely the opposite, isn't it? Because who's ever seen a share devalued to such an extent that it gets completely delisted from the Australian Stock Exchange? Yeah? Anyone? OneTel, HIH? Who's ever seen a property in a suburb, doesn't matter how bad it is, devalued to such an extent that one day just disappears and the two houses opposite come together and property number 19 is gone. Anyone see that? Just doesn't happen, does it? Because people have to live somewhere at the end of the day. So the reason the property market is much more less volatile, I guess, than the share market, and I'm not giving advice here, I'm just generally just discussing different markets, is because that 70% of the market isn't based on investment speculation or investor sentiment. It's actually people living there. There's only 30% of the market that is affected by people speculating on the area. So commercial property is also something that gets really, and also the valuation process is much different. When you value a residential property, you're looking at 3 comparable sales within 6 months within a 10% price point. When you're looking at commercial property, the valuers actually look at the lease. So in an economic downturn, commercial properties get affected much more than residential property. Hence, there's a lower LVR on commercial property.